So, if people have crossed that level for the first time this year, all of a sudden you're sending more money to Ottawa and to Toronto in your taxes than what you get to keep on your next dollars earned. So, we can't control everything, but we can certainly help people with that. And, I like to help people save money and help them save taxes.
Hey everybody, Ryan Hodge here with the Realty Firm and Ryan Hodge Coaching and Consulting. And this is another episode of my Rise Up podcast, where we like to bring those that have an influence and those that can lead, serve, and inspire others to achieve more in any space that they desire. And I am fortunate to bring good friend, colleague, and actually even a past client into this realm today, Jamie Campbell, who is a portfolio manager and also a financial planner with BMO Private Wealth. So Jamie, welcome today.
Thanks, Ryan. It's great to be here.
So one of the reasons that I thought that we would, have you, come in and discuss things is that we've had multiple conversations on, a pretty popular topic right now for realtors, especially in the province of Ontario, which is incorporation. It was just in the last little while that realtors were able to create personal real estate corporations. And I thought, some of your insight and skill set helping people, build wealth would be beneficial. But maybe you can take us through a little bit of your background, where you started, to where this has led to now, and then we can dive into the main topic at hand, which is the personal real estate corp.
Yeah, for sure. So I think probably the most relevant piece of the puzzle or my background is I go back to 2006. I got hired and started working for a company called MD Management. At the time, they were a wholly owned subsidiary of the Canadian Medical Association. And the key with that is it was working strictly with physicians and their family members. And the reason I mentioned the 2006 is the physicians in Ontario went through a similar process. In 2005, they changed the legislation where they were allowed to incorporate their medical practice. So it spent a lot of time in the first couple of years talking to physicians. Should I do it? Should I not? What are the benefits? What are the drawbacks? And a lot of them thought it seemed too good to be true. Like, why is the government now allowing me to incorporate my practice, shelter so much of my income and not have to pay such a high tax rate personally on it and move forward? So there was a lot of cynicism, but it was overcome. And walking people through that process and watching them over the years be able to build the wealth and build that inside of their corporation, it's something that's translated. So a few years ago, when I left that firm and started my own practice, I've been able to translate that not just to the physician world, but working with all professionals that have the ability to incorporate their practice, albeit dentists, lawyers, and now real estate agents have that ability as well.
Mm-hmm. And so that is a real question that I certainly receive as a broker owner, but you can certainly lend some insight, because obviously not every real estate agent or real estate professional has doctor money like physicians do. However, many of them, certainly, generate a whole bunch of commission. So I guess one of the questions that I have is, when somebody says, they don't think that they need to, but, really, why should they actually explore it, in terms of incorporation?
Yeah, there's no one kind of paint everybody with the same brush answer for this, but it's really to sit down and say, where's your income level at? And where do you expect it to go? Are you in the growth phase? Are you just coasting towards retirement? Are you doing a few deals a year? Really, what I look at, if anybody has the ability to save money, if they're not spending every dime that's coming in, there's probably benefits to being able to incorporate. If you've seen your income increase, we all know what's gone on in the real estate market over the past couple of years. And I'm sure that there's a lot of people that have made more money in the past couple of years than they ever thought they would. Mm-hmm. So, it's taking a look at that and saying, is there the ability to save some? Or there's people that have probably jumped tax brackets or about to jump tax brackets. Maybe for the first time ever, they're crossing into that 53% tax bracket when they do their taxes this year. And they're going to be like, wow, is there a way to protect some of this and keep a lot more of what I make? So it really is individual, but it really comes down to where you're at, what your income level is, or where you think it might get to. And, are you spending everything, or do you have the ability or desire? And a lot of times that's what I'll work with people through as well. We say, I can't believe I'm spending all this. They don't really think about it till the end of the year, and they're like, wow, there's my income. Where did it go? So
Right.
you sit down and you try and help people through that and say, well, let's take a look at it. Nobody likes to hear the budget word and be put on a strict budget. But if you can be put on a plan to say, you know what, yeah, I can live on $10,000 a month, or whatever that number is that you want to work within, then I can certainly help people if there's a desire to build wealth.
Hmm. We've put together probably a third of our companies operating under our personal real estate corp now, and I certainly appreciate the insight from you, outside of the real estate environment. But a lot of people, the common question is, it seems so complicated to set up, a personal real estate corporation. Do you feel that it is, or what are, the basics as far as understanding what it actually means and what it entails?
Yeah, and I think people can get overwhelmed because it's something different. You're adding another taxable entity, you're adding another tax return. You do have to see a lawyer to get it set up. You do have to have a full CPA to file your taxes for you if you had been doing your own or working with more of a bookkeeper in the past. But at the end of the day, once that's done, it's a band-aid. You rip it off once. There's going to be a bit of a cost, but again, all those costs are tax deductible to your corporation and setting it up. So it's not the end of the world. And in my opinion, the benefits far outweigh it if you have those other pieces that you're looking to be able to do, whether it's saving extra money inside of your corp, reducing your overall tax bill, not to mention the other things that you can put through your corporation, like life insurance and other benefit packages for yourself.
Hmm. And so, are those the things that you support in? Because a lot of our members will say, okay, now I've got a personal real estate corp, or a few of our members have a full franchise, which means they've got a full corporation. What do they do now that they have it set up? Because that's kind of if there's one thing to start paying into it, but what's the next step once you've actually incorporated it, or if somebody's sitting there going, okay, I've done this, but what do I do next?
Yeah, and that's a great question and great point, because you get lost in the details. Like, okay, here I am. Now, what do I do with this thing? And that's where I like to sit down with people. And we a lot of times we'll circle in the accountant at that time if they've got an accountant that they've been working with. If they don't, I've got a list that I can bring in and find a nice partnership to gather. But we sit around the table and we come back to the plan. What do you need to run your household? What do you want to run your household on a personal basis, on a month to month basis? And we can smooth out the income. I'm sure you experience it in the world, and many of your agents experience that, where 1 month does not look like the next month. You don't have a consistent 12-month income level. So what we're able to do when you incorporate is the corporation's the basket that catches all of the income that's coming into. And then you set it up where you're paying yourself, and it could be a salary or it can be a dividend. And we can get into the differences between those two as well. But you pay yourself what you want on a monthly basis, and just what you want. So when you have those big months where you've received significantly more commissions than you'd had in previous or in the future months, you can capture that inside of it. And then at the end of the year, you settle it all up. The goal is that you're keeping some of this money in the corporation, because the corporate tax rate is significantly lower than anybody that's up over that $230,000 level, where they're paying the 53% marginal tax rate here in the province of Ontario.
Mhm.
So, if people have crossed that level for the first time this year, all of a sudden you're sending more money to Ottawa and to Toronto in your taxes than what you get to keep on your next dollars earned. So, we can't control everything, but we can certainly help people with that. And, I like to help people save money and help them save taxes.
Mhm. It's always a big surprise, and we have a lot of members that have had outstanding trajectories with their business growth inside of our company, and I'm sure with many companies. But they have this huge banner year, then come tax time, it's a big surprise for them just how much they're going to be paying, which certainly can create challenges if they haven't allocated funds for that as well. They're all of a sudden playing catch up. When you look at the dynamic of what's happened in Ontario, it seems, that it can appear complicated at times because the government, can sometimes change the rules. Is that happening right now, or what do you see with personal real estate, corps or incorporation and government rules?
Yeah, that's a wild card. That's one that every year we watch the budgets closely to see what tax changes may come in, what they might attack, what they might go after. And you don't all you have to do is look at the last 19 months. We've seen provincial and federal governments spend billions and billions of dollars. That money has to come from somewhere. So whenever there's appears to be a tax break, a tax haven, a tax solution, you always worry that that's going to be something they're going to zero in on a future budget. And we did see that in the physician world a few years ago, where you used to be able to have your spouse as a shareholder on your medicine professional corporation. So you could pay a dividend out to your spouse, whether they worked in the practice or not. They took that ability away. But one of the things that they didn't do, that they tried to, and it's been challenged and then since overturned, is that even if you can't have a spouse or another family member on your corporation while you're working, once you reach the age of 65, it's considered a family asset. So you are then able to bring your spouse in as a shareholder. So if you've been saving inside of this corporation all the way through, in retirement, you can now income split. So again, coming back to the graduated tax rates that we have here, we know that one person making $120,000 a year is going to pay significantly more tax than two people making $60,000 each. That's just the way that our tax system works. So you can still build those assets up, save it when you're in a much higher tax bracket personally. So you're not paying maybe that 53%. You keep it in there, it grows over time. And then in retirement, when you're in a lower tax bracket potentially, or you can split it between you and your spouse as well. So it really becomes short-term income tax planning and cash flow management, but it also builds into the longer picture with regards to your overall wealth plan and what your retirement income is going to look like.
For sure. So we touched on, salary and dividend. Can you kind of explain, really what dividends are, how they work? I think a lot of people just think that, they're going to pull something out of the company and that's just that. But can you kind of explain it so that people understand, how dividends actually work and, how it incorporates, I shouldn't use that word right now, but how it, I guess, goes with a salary, or are they completely different?
Yeah, no, for sure. There really is. There's two main ways to get money out of your corporation. That you can pay yourself a salary, or as you mentioned, you can take the dividend out. The biggest difference is the treatment of the taxes. A salary is an expense to the corporation, so it comes out as pre-tax dollars. So if you put $300,000 into your corporation over the course of the year, and you paid $200,000 out to yourself as a salary, the corporation is only responsible to pay $100,000 of its own income tax. So it's only taxed on that $100,000 of retained earnings that are left inside of the corporation, because you are going to pay tax on the 200. The one thing that our system does allow is to make sure that there's not double taxation. So you don't pay tax corporately and then pay tax as you take it out as a salary.
Right.
A dividend comes out of the retained earnings. So the corporation has already paid the tax on those dollars, and then it comes to you as a dividend. A dividend in Canada and in the province of Ontario has a lower tax rate than a salary. So you don't pay as high of a tax because you've already paid some tax on that money inside of the corporation. Then you pay it out to yourself in the form of a dividend. It's lower. It used to be a bigger difference. There used to be about a 4% spread, that if you paid yourself a dividend, $100,000 in dividends versus $100,000 in salary, overall you paid less tax via the dividend route. Again, I come back to when they find these so-called loopholes, it's playing within the rules, but they will then increase the dividend rate. When I say they, it's going to be the federal or the provincial governments when they release their budgets. But the key difference between a salary and a dividend, and again, it comes back to the overall plan. When you pay yourself a salary, there's the payroll deductions. You have to pay your CPP and you have to pay your EI pieces that are going to be taken off that. So you're going to have your payroll taxes, but you're also going to build RSP contribution room. So again, just we don't want to dwell on taxes the whole time, but incorporation, really, a lot of it has to do with finding the most tax efficient way to get cash into your hands now and over time. So if you pay yourself a salary, or right now as you're earning income, if you're unincorporated, 18% of that, up to the maximum amount per year, you're allowed to contribute to your RSP in this year or in any subsequent years. You can build that room up. Dividends don't build RSP room. So it's very important to make sure that people, if they're paying dividends to themselves, to avoid paying the CPP premiums, both as the employer and the employee, that they know that they're not building the ability to contribute to their RSP. Sometimes that's okay. Maybe people have already built up enough. Maybe they have enough room. Maybe they're going to use their corporation as their retirement fund, and they're going to build all of the assets in there because they don't want to be told down the road, once you're into your 70s, a minimum that you have to take out of your RSPs.
Right.
So
we talked about, paying yourself a dividend, but what else can you pay for through your corp? What other things can people pay for? And why are they beneficial?
Yeah, great question. One of the biggest benefits that we see is life insurance. So life insurance, whether it's just a straight term insurance that somebody has to protect their family, or whether it's a whole life insurance or universal life insurance where they're building up this permanent policy to build assets in over time. You can pay for it inside of the corporation. If we go back to, let's assume again, we're going to go back to this top tax bracket because it's a nice one to pick on. So somebody's making over that $230,000 after expenses. If you're paying your life insurance premium personally, you've already paid 53% on those dollars. So you're paying with it for the 47-cent dollar. So it's costing you a lot more to pay those premiums than if you pay for it inside of your corporation, where the tax rate is significantly less. Mm-hmm. So if you're paying with an 85-cent dollar, because you've only paid 15% corporate tax, or whatever your corporate tax rate is going to be, it's going to be a lot less than that 53%. Your money goes so much further. And the reason I say life insurance is because life insurance gets paid out tax-free. It still gets paid to your corporation, but it flows through a mechanism through the capital dividend account that goes out tax-free to your intended beneficiaries anyway. So there's no tax consequence. There's no harm in doing it that way. And you can move existing policies even from personal into your corporate entity without any consequences. So that's certainly one of the biggest ones to look at right away. One of the other things that people will look at is they'll set up their own health and welfare accounts. So you can set up your own benefits accounts. You can create those that can then cover yourself and your family members. And again, you can do that with corporate dollars, which are much more tax efficient dollars than if you were doing that personally on your own, setting it up.
Interesting. When you look at, we talked about spouses, but what about kids? Can the kids be part of it, or how does that work? I mean, I've heard all different things of what you can do with, kids or the employees, that kind of stuff. But how does it really work with children?
Yeah. So again, back prior to 2015, you used to be able to have your adult children on your corporation once they turned 18, and then you could give them a dividend as well. So it's a great mechanism for helping through university or college tuition, or helping the kids get started before they were really into the workforce and making their own income. That again was eliminated. So that's been gone. There's really not a way to make the children shareholders at this stage. The rules have been changed that doesn't happen. As far as paying the children, as long as they're doing something that you would pay somebody else to do. So maybe it's filing, maybe it's putting up the signs, maybe it's, coming into the office and doing a little bit of stuff for you, but it has to be justifiable. You're not going to pay your 13-year-old $100,000 a year and say that they were taking care of the filing, because you have to be able to justify that if they weren't doing it, somebody else would have been able to do this, and it would have been a similar amount that you would pay them.
Makes sense. What about CPP?
CPP, yeah. So yeah, sorry, I should have mentioned that on the salary versus the dividend one, because similar to the RSP, if you're paying yourself a dividend, you're avoiding having to pay your CPP premiums. However, if you're not paying your CPP premiums, you're not contributing to CPP. So that's a benefit that you're not going to be fully entitled to down the road. Again, depending on how many years maybe you've already contributed. Maybe you've contributed for enough years that you're going to get the bulk of your CPP because you've already been paying into it for 25 years. But if you're just getting started and saying, well, I really like the sounds of this incorporation, it's something that I can take control over. I don't have to rely on, there's a lot of people will say, well, is CPP going to be around? Is it a viable solution? Can it continue? Well, we're not going to get into that discussion today, but as it stands right now, every year that you contribute, it increases the amount of benefit that you're going to get as early as 60, but sometime between the age of 60 and 70, if you start claiming your CPP benefit, you get a monthly paycheck from the government. But that is based on how much you've contributed over the years.
Right.
So if you decide not to go the salary route, you pay yourself a dividend, you're not building RSP room, you're not building your CPP benefit. So you better make sure that that's tied into your overall financial plan to know that, okay, well, these pieces aren't going to be there. I got to make sure that you're saving enough somewhere else to provide you with that income, because I don't think anybody's planning on working until the day they die.
No, let's hope not. You're not an accountant, you're not a lawyer, obviously, but how do you help people with incorporation and navigating through this process?
Yeah, I think the biggest thing is, and not to upset any accountants or lawyers that might come across this, is that how I work is I've got 15 years of expertise working almost on a daily basis with people that are incorporated. So I see the ins and outs of it. Again, yeah, you're right. I'm not an accountant. I'm not a lawyer. I probably know enough about taxes to get myself into trouble in some of the tax conversations that we have, but we always defer to the experts when it comes to that. But I also am not charging on a transactional or on a hour by hour basis. Any of the clients that I work with, I'm on a fee for service basis. So I'm managing their portfolio, I'm creating their financial plan, and it's not based on the conversations or the amount of time that I'm spending with them. It's all part of the overall asset management that we're working with. So I sit down and we work through and kind of do a lot of the legwork to say, okay, well, what is the best mix of salary versus dividends? How much does it make sense to pay yourself? What are you earning? What do you think you could earn? What do you think you could live on? Really get into the weeds on that, come up with a cash flow plan, really try to set up what we call an efficient income model. And then what I'll do is I'll send it to the tax professional. I'll send that to the accountant so that all of the legwork has been done, just to get the sign off on it and say, here's what we're thinking. Here's why we're thinking it. This is the rationale behind it. What do you think of going this way? Because we're going to rely on them to be preparing our tax slips. They're going to create the salary of whether it's T4, if they're going to be paying out dividends, the T3 slips, and all of those other pieces. They're going to be part of it anyway. But if I can do that legwork, if I can kind of combine it with what the goals and objectives are, it takes a lot of the time away from the accountant so that they can say, yeah, no, this is what it is. Or, well, yeah, but what if we do this? And then we can have a very quick conversation rather than sitting down and walking through that whole spiel.
Awesome.
So that's where I feel that we're adding a lot of value and really able to help people right from the beginning, have that discussion. Does it make sense to incorporate? And then once it's made sense, okay, well, let's make sure that we're making this worth our while, because like we said earlier, it does cost money. You're paying an extra fee every year to file your taxes. You're paying the initial setup, but I have never seen a circumstance where we're not recouping those costs almost immediately within the first year. And then every year after that, it's just building and building and building.
I have a quick question about that, because some of the folks that we've worked with are, highly productive husband and wife teams of partnerships. They want to do PRECs. Is it still worthwhile if they're earning enough revenue to, do that, even though there's two of them?
Yeah, I think it becomes even more beneficial when there's two of them, because you can put both on it, and then you do have the ability to income split right from the beginning. So no, it's when you've got the two spouse combination, that's, in my opinion, where you can probably get the most, pardon the pun, bang for your buck out of incorporating.
Sure. Well, this has been a wealth of knowledge, that I know will benefit a lot of, realtors, a lot of other people. When it comes to, the partners that you have, let's say somebody has, their own accountant that, they've been loyal with, they can still, hire you or retain your services and use their accountant. I just want to be, clear on that. Is that accurate, or do
Yeah,
they need you to
yeah.
be partners? Okay.
No, for sure. I'm not in the business of breaking up existing relationships,
I didn't
and
think so.
no, we can always sit down with the existing accountant, and you find there's a group across the city that specialize in incorporation, and they're great, and I work with a number of different accountants across the city, and yeah, no, we're like I say, not here to break up relationships.
Yeah, I didn't think so. I just wanted to make sure that it was
Yeah.
clear for
No,
the
good
audience.
question though.
Where can people find you as far as, where can they, connect with you to, discuss these things, to, find out about your services, how you can help them, whether they should, incorporate? What are the best avenues or channels that people can locate and connect with you?
Yeah, so the website, the Campbell Wealth Management Group.com, is a great way to go in. There's some videos on there. It talks about some of these specific things. There's stuff about estates, about wealth planning, and that they can reach out directly. My name, jamie.campbell at nbpcd.com. Probably one of the worst emails possible, but it's Nesbitt Burns Private Client Division is what it stands for. But yeah, those are the easiest ways to connect via LinkedIn as well. I'm on there and try to be fairly active as well.
Good stuff. Well, I'll get the bulk of the contact info, and we'll post this. I'm going to make sure that I post this not only for the members of the realty firm. We believe in the spirit of contribution and abundance, so we want to post this for other real estate professionals in all of our markets and Ontario and groups, because I think a lot of people could benefit from your services. But I just want to say a heartfelt thank you for coming on and sharing a little bit about this very, very relevant topic today. I certainly appreciate the time, and I know you're a busy fellow. So.
All right. Thanks for having me, Ryan. It was great.
Awesome. Everybody, Jamie Campbell, I will be certain to post all of his contact information. If you're thinking about building wealth, or want to get started in incorporating, finding out the do's, don'ts, will it be effective for you, Jamie would be an excellent person to connect with. I know that he has helped many, many people build wealth over the course of his career. And I think that in the real estate profession, it is important to really focus on that versus just the commission that we're earning. As always, it's an honor to serve and support you here in one of my Rise Up interviews. Be sure to tune into other future interviews where we bring on guests that will lead, serve, and inspire you on a number of different topics. Thanks again for being here, and we'll connect real soon.